Hi everyone, just wanted to welcome you to this session of our client summit that we're doing here at Paradigm. It's December 2016. For those of you who don't know me, I'm Nate Butler. I've been here with Paradigm for about 4 years and I've been in the financial services industry for about 10. I've learned a lot and I feel very blessed to have been a part of everything that I've been a part of up until now, and to be a part of my clients' lives. And to be able to provide a better financial future for them using the products and the strategies that we implement here at Paradigm Life. So there's a lot of sessions they're going to be happening over the next couple of days. I think there's something like 30 sessions, and it's going to cover a lot of different topics. But to kind of break it down, or to kind of boil it down to three main categories that we're going to be covering. Let's go to the perpetual wealth strategy, which includes the three different financial phases. So the first financial phase is the growth phase. Now we all go through the growth phase, and the whole point behind the growth phase is to have your assets grow to a point where they can start creating income for you, and then whatever you don't live on as income, or whatever you don't use for income, ends up becoming legacy to your kids, to your family, to friends, to charity, to whoever you want. But the point here is we want to make it so that we transition these phases in the most efficient way possible. That's the key. And there's a lot of different products and a lot of different strategies out there. So I'm going to try to keep it as simple as I can with what I'm going to cover today. There are a lot of different topics that we're going to cover over the next couple of days. So please go on and watch those other sessions. There's going to be a lot of really good information in there. For today, I'm going to focus on the income phase. And more specifically, how do we make sure that we create a tax-free income when we're getting into the so-called retirement phase. Now, just a quick note on retirement. I feel like what retirement has become is generally you put your time in and then you retire at age 65 or 66 or 67, and you live for another 20, 25, 30 years on whatever you've built up, and you just sit on a beach, or you don't work and you don't produce and you don't carry on the same lifestyle that you were carrying on before. My opinion on that is, in order to have a healthy life and to live a long and happy life, one important thing for that is to live a productive life and to always be providing value for those around you. And as a result, you'll have good health. You'll always have a purpose that you're driving for. So this idea behind retirement, generally, I don't necessarily agree with. However, from a financial independence standpoint, we want to make sure that we can create enough passive income so that we can cover our essentials, our needs, our living expenses, and our lifestyle, traveling, vacationing, whatever it is that we're going to do. So, and one important thing here is taxes. So whatever income you're bringing in, if it's a gross income, you're also going to have to consider the taxes to then figure out how much net income you're going to be able to receive. Okay, so let me get into the tax-free income, tax-free retirement. And I'm going to get rid of my camera now, just so I have the full screen here. Okay, so during the growth phase and leading up to the income phase, I'm going to refer to a kind of a couple of principles here, and I'm going to call this the dual economic risks. Now, these dual economic risks are risks that we all face. Now, for those clients of mine that are listening, I know that I've covered this with a lot of you, so I'm gonna go through this quickly, and then we will get into how to create a tax-free retirement. So, dual economic risks. So what am I talking about there? when you get into retirement, one of the things that the retirees fear the most is running out of money. So the first risk that I'm going to talk about is living too long. Or in other words, outliving your assets. So making sure that your assets are sufficient is an important thing. And the issue here is we don't know when death is going to occur, of course. And so we don't really have a number to calculate based on to know exactly how much we can spend. In the financial services industry, they've come up with their solution to making sure you don't run out of money given life expectancies of 85 to 90 years old. And their solution is what we call the Monte Carlo, or it's also has been known as the 4% rule. That's been challenged, and I'm going to use the 3.5% rule. So 3.5%. What that means is, if you have $1 million saved up in retirement, you can take 3.5% of that as an annual income for the rest of your life. This is assuming a retirement age of mid-60s. So in other words, you can take $35,000 per year for the rest of your life, and that will over time deplete the asset base down to zero. So you live on the principal and the interest associated with it. The reason that this is so low, and I believe it is low, is because of if you're invested in the market, then you have volatility to consider. Volatility. There's what is called the sequence of returns risk. In other words, when are you going to get those negative years? You've got fees to consider. Fees are going to erode the account balance as well. And there's several other things here that we've got to consider. But ultimately, these risks are what create this 3.5% distribution rate known as the Monte Carlo. Now, that's the first risk of the dual economic risks. The second risk is dying too soon. Now, for me, I'm young. I've got young kids at home. My wife stays at home to take care of our kids. They are completely dependent on my income. So if I die too soon, that's a huge economic risk to them, and I want to make sure that they're taken care of whether I'm here or not from a financial standpoint. So the very best way to do that is to do that using life insurance. Life insurance. Now, the typical financial advice is to buy term insurance and then invest the difference into the market, which then eventually from an income standpoint is going to create this amount of income based on $1 million having been saved up. But our solution is a little different than this. We want to hedge the risks, and the way in which we're going to do that is by creating a private pension. Now, private is an important part of that, and I'll get into why it's private, but one thing that I'm talking about here, one thing that refers to is the fact that we can create a tax-free retirement income if we set ourselves up properly right now, so that income can be coming out on a tax-free basis. So that's an important thing, and we'll get into the details with regards to that. But and again, somebody else is going to cover this in much more detail from an income standpoint, not the tax-free part, but to create the most income instead of having to be relegated to the Monte Carlo distribution rate. There are better ways to do it. One of those ways is to use an income annuity. Okay, so if this income annuity is paying out on a single life, then it'll pay out at about a 7% distribution rate. If it's being paid out on a joint life, meaning as long as at least one of the two, husband or wife is alive, it's going to continue to pay out. Now, it's going to pay out a lower distribution rate, but it's going to be more like 5.25%. So both of those are much better than the 3.5%, but there is some give up of liquidity, access to the full balance of the money by putting it into the annuity. But there are some provisions we can add to these annuities to create liquidity and still create the income that's needed. So that's one way to hedge the risk of living too long, because these income annuities last and pay out for as long as the annuitant is alive. Now, the concern for the single annuity is, what if the annuitant passes away early? Then the income from the annuity stops. The very best way, and that kind of gets back into the second risk, which is dying too soon. Again, the best way to hedge the risk of dying too soon is life insurance. So in order to hedge that risk, we then use a properly structured whole life insurance policy with paid up additions to get the death benefit in place, but also provide a lot of liquidity inside of the contract as well. So from a 30,000 foot view, that's one solution for creating guaranteed lifetime income and hedging the dual economic risks. Now let's get into the private part, which is the tax-free part, and how do we create a tax-free income in retirement. Okay, so first of all, I want to go over really quick tax deferred versus tax-free. Okay, a typical tax deferred account is going to be like a 401k or an IRA. A tax-free account will be a Roth IRA, a Roth 401k, or of course the properly structured life insurance policy that is a non-MEC policy. Okay, so let's assume that we've got $10,000 per year gross, so this is before taxes, that we want to save. And let's assume we're in a 25% tax bracket, and we're going to save each year for the next 11 years, and we're able to get a 5% net return after volatility, after fees, and so forth. We're able to get a 5% net return each and every year. Now, if we're invested in a tax deferred account, we're able to take that full $10,000 and defer the tax on it, and it's going to grow to a future balance. So I'm going to grab a quick calculator, and I'm going to figure out what that future balance would be. So $10,000 per year, growing at 5% over 10 years, grows to $132,068. $132,068. Now, on the tax-free side, we've got to take that $10,000 as income today, pay 25% tax on it, and we walk away with $7,500 net, growing at a 5% return, grows to just $99,051. And actually, I just realized that I'm running this based on a 10-year time period, so not 11 years. So I'm going to change that to 10 years, and ultimately we're going to keep the same. We're going to keep the variables the same essentially for the tax deferred versus tax free. The only difference is the tax and when it's taken. So we've got $99,051 on the tax free side. Now, the important thing here is we've already paid the taxes on this money, and the growth is now tax free, whereas the $132,000 in the tax deferred account, you still have to pay tax on it. You have to pay tax on the full balance. Now, from a tax rate standpoint, if tax rates stay the same, we've got to subtract 25% out of that future balance to get the equivalent net balance of this account. So I'm going to grab a calculator, and we're going to say $132,068, and I'm going to multiply by 75% to get the net balance. So the net balance becomes $99,051. $99,051, which is exactly the same as the tax-free account. So tax-deferred versus tax-free is the same as long as tax rates stay exactly the same. Now, what are tax rates going to do going into the future? We don't know for sure, but I think we can make an educated guess based on the spending that our government's doing and so on, and the amount of debt that we have and so on and so forth. I think taxes are going to go up in the future. So as tax rates go up, then the tax-free vehicle becomes more advantageous and a better financial vehicle than the tax-deferred account. Okay, so that's a quick explanation of tax-deferred versus tax-free. So I want to make a recommendation here. The comptroller, the U.S. comptroller, is basically the accountant for the United States government. Okay, so there's the prior or the previous comptroller of the United States government his name was David Walker. David Walker. He resigned after he saw what was happening and after he saw the hole that we were digging ourselves into and the fact that we're not stopping the digging and we're continuing to dig a deeper and deeper hole. He resigned and became a whistleblower. And he wrote a book called Come Back America. Come Back America. That is a very good book that I would recommend that you read. But basically what he says in here is in order to dig ourselves out of the hole, taxes would have to go up by 50%, or spending, the IRS, the government would have to spend 50% less, or some combination of both of those. So some combination of both of those in order to dig ourselves out of the hole. Now, I'm not seeing that spending is going down, and I'm not seeing that taxes are going down. I see the opposite happening, which goes to show, or you might make an educated guess, thinking that taxes are probably going to continue to go up. Taxes are going to have to go up in order to make sure we don't go bankrupt as a country. So, if taxes go up in the future, then tax-free becomes much more valuable. Now, let's talk about how to create tax-free income in retirement. So first of all, Social Security. Let's talk about Social Security. So and how Social Security is taxed. So tax on Social Security. Tax on Social Security. What this is dependent on is what is called in the IRS code your provisional income. Your provisional income. Now, if a person is single, then the provisional income limits are different than if the person is than if we're comparing to a married couple. Okay, so based on the provisional income limits, that's going to determine what percentage of Social Security is taxable. So it'll determine what percentage of your Social Security is taxable. Okay, so if you're single, the provisional income limits are these. If your provisional income is less than $25,000, then 0% of your Social Security becomes taxable. If your provisional income is anywhere from $25,000 to $34,000, then all of a sudden 50% of your Social Security becomes taxable. And if more than 34,000 of if your provisional income is greater than 34,000, then 85% of your Social Security becomes taxable. And it's taxed at the income tax rates. So the way our tax system works, it's a progressive tax system, and the more income, the more taxable income you have, the higher the tax rate's going to be on that taxable income. As a married couple, if your provisional income is less than $32,000, then 0% of your income is taxable. If it's between $32,000 and $44,000, then 50% becomes taxable. And if it's greater than $44,000, then 85% becomes taxable. So those are the provisional income limits. Now, what makes up the provisional income? Or what does provisional income consist of? Provisional income consists of half of your Social Security, all of the yield that you take from your taxable bucket, so brokerage accounts and so forth, anything that's a non-qualified vehicle is going to be in the taxable bucket, and any yield that you get on that becomes part of your provisional income. 100% of income, 100% of income from the tax deferred bucket. Rental real estate income, 100% of earned income, typically pension income has been, it's a tax deferred vehicle, so pension income can become provisional income as well. So those are the things that the provisional income consists of. And it's obvious here, if we go back to these limits, because half of your Social Security and all of the income coming from the tax deferred bucket count towards a provisional income, it's obvious that most people with very traditional planning in place are going to exceed the $44,000 maximum, which then creates an 85%, or it makes it so that 85% of your Social Security becomes taxable. Now that's problematic, obviously, because if now 85% of your Social Security becomes taxable, now you've got to pay more taxes and therefore pull more income out of potentially your tax deferred bucket, which then is going to be taxed at a higher tax rate, requiring you to pull more and more income to just cover the tax that happened on the Social Security. Okay, so that's the first thing that could create a problem in retirement from a tax standpoint. So how do we get to this number right here, the 0%? How do we get to a tax-free retirement? So what I'm going to do is, well, first of all, we want to make sure that that our capital is in tax-free buckets. So there's only two different truly tax-free buckets out there. That the income from these tax-free buckets does not count towards provisional income. And as long as your total provisional income is under $32,000 as a married couple, then none of your Social Security becomes taxable. Okay? So what we're going to do is a case study. Well, actually, before I jump into that, those two vehicles. The first one is the Roth IRA. Okay, so you put money in, you pay taxes on the money before it goes in, it grows on a tax-free basis, and then all of the income coming out is tax-free, and it does not count towards your provisional income. The second vehicle is the properly structured life insurance policy, the non-MEC policy. So you build up values inside of it. Any income you pull from it does not count towards the provisional income limits, and it's tax-free as well. So those are the two financial vehicles that are tax-free and that don't count towards your provisional income limits. So let's do a case study. Okay, here's our case study. So we're going to look at a husband and a wife, so a married couple. And I'm going to keep this really simple, just to be able to go through the math. And everybody's situation is going to be a little different. So obviously, reach out to us, call us. If you want to learn more about this, we're happy to help, and we can put your specific numbers to the calculators to understand what makes the most sense for you. So husband's 55, wife is 55. From an income standpoint, their gross earned income right now, his is 100,000. We're going to say hers is 75,000. Then we're going to say that their retirement age is at age 66. So at age 66 for each of them. So in other words, we've got 11 years to continue to save up. Okay, so that's kind of our case study. And we're going to get into how much money they've been able to save. In other words, how much money they have in their tax deferred, their tax free, and their taxable buckets, and how much cash flow do they have disposable, and then how much income they need to retire on, and so forth. And we're going to look at, based on the course that they're currently on, how much income that will create, and then we're going to realign, and we're going to redirect some of that cash flow. And we're going to implement the strategies that we're going to talk about and look at how much more spendable income that will create, and we're going to see if we can get them in the tax-free bucket. Okay, so here are the details of our case study and our hypothetical couple. You got individual 1, individual 2, John and Jane Smith, each age 55, retiring at age 66, which is 11 years out. John is earning $100,000 per year gross. Jane is earning $75,000 per year gross. And then their current capital assets, they have in their total combined tax deferred bucket, they've got $100,000. In their tax free bucket, they've got $250,000, which means they've been contributing to their Roth IRAs for the last couple of decades. They've got $50,000 in let's say a brokerage account. And then of course we've got what they can contribute on an annual basis if there's an employer match. And then I'm going to put over here we've got an annual rate of return. Now I'm going to use a 5% net annual return for all of these accounts. I'm sure that there will be another session where somebody's going to cover the growth phase and they'll really talk about average gross returns versus actual net returns and what is realistic in the market. 5% net based on historical data I think is probably a little bit high as a return in the market, as a net return, but I'm going to use it just the same. So 5% net returns. We've got a 5% state income tax that I'm going to use, and then I'm going to use $35,000 of tax deductions here. Now, a quick note is currently there are you can itemize deduct, or you can do standardized deductions and personal exemptions. Now, for a married couple, worst case scenario from standardized deductions and personal exemptions, you can take $20,700 as deductions right now. From a provisional income and tax standpoint going forward, that the standardized deduction and personal exemption is typically what retirees use in retirement because they've lost their tax deductions that they had during the growth phase, and so the standardized deductions and personal exemptions become better than itemized deducting. Now, standardized deductions and personal exemptions are tied to inflation, so that deduction increases over the years by the inflation rate. This calculator system takes into consideration the current our current progressive tax system as it is, and so we can start plugging in the numbers, and it's going to give us our disposable income. So right now I don't have any savings going in, I don't have any monthly or annual expenses and so forth. So let's start with how much they're going to save for their personal or to their tax deferred vehicles. Let's just say that they just got done paying for college, the kids are out of the house, and they're really able to save quite a bit of money. And their first place that they're thinking is $24,000 per year, which is the maximum to each of their 401ks, for a total of $48,000 per year going into their tax deferred bucket. Now let's also assume that the employer is going to match about $6,000 of that, which is 3 to 4% of the total income. So $6,000 per year. The next, we're going to assume that they are going to continue to max out the Roth IRAs, $6,500 per year each, so $13,000 total. And then we're going to put into the taxable bucket. Well, actually, let's go up to the monthly expenses. Let's say that they've got $6,500 in monthly expenses, and per year they're spending an additional $12,000 for vacations, Christmas, maybe property taxes and things like that. Okay, so what this does is it gives us a disposable income after it takes into consideration the combined taxes, which is based on the total income minus what they're contributing to the tax deferred accounts, minus tax deductions, and then it puts it into the progressive tax system, and it also includes the 5% state tax. So after their combined income tax of $17,992, they're left with $6,008. So we're going to put that into their taxable bucket. So now we've allocated all those dollars accordingly. Their current living expenses would be $90,000, which is basically the monthly expenses times 12 plus the annual expense. So $90,000 per year is their annual living expense right now, and that's the lifestyle that they're living. So given where they're at with the 5% return per year, over the next 11 years, this is what it would look like in retirement. So their tax deferred bucket would grow to $976,000, $621,000 in their tax free, and $175,000 in their taxable bucket. $141,000 would be their cost basis for a combined total of almost $1.8 million. We're going to use a Monte Carlo distribution rate for income purposes of 3.5%. Let's use a Social Security inflation rate of 2%, an inflation income rate of 2%, and a long-term capital gains rate of 15%. Now, given this inflation rate of 2%, their living expenses in the future would then be $112,000 per year to have the same lifestyle as $90,000 has today, because we're 11 years later with a 2% growth rate on that. Okay, so that's their capital assets in retirement. Now, the retirement income sources, other than capital assets, you've got Social Security, earned income, real estate income, and pension income. Just to keep this simple, I'm just going to use Social Security. And I did a quick calculation of what their Social Security would be on the IRS website, and this is what it kicked out to me per month for each of them. So that's an annual total of $52,920. And now we can jump into what that would look like from an income standpoint, and more importantly, how much net income this will create. Okay, so so the first section here is the year. So in year 2027 is when this couple would retire. Each of them would be age 66. John's Social Security would be $27,972 per year. Jane's would be $24,948. This section is their capital assets. So the future value of their tax deferred money would be $976,000, $175 of their taxable bucket, and $621 of their after-tax bucket. So they're in a good position because they have a good amount of money in their after-tax bucket or their Roth accounts. But the problem is they have so much money in their tax deferred bucket that they're going to start creating some taxation on their Social Security, and of course the income coming from this account is going to be taxable. So I'm going to take away these numbers. So basically what this is going to calculate, and I'm going to base it on Monte Carlo actually. Monte Carlo for each of these three categories. So if I plug in $976,559, and if the distribution rate for a Monte Carlo simulation is 3.5%, the annual income from that bucket would be $34,180. From the taxable bucket, they've got $175,139. So they're able to take $6,130 as an annual income. And then from their after-tax bucket, they're able to take and use $621,507. That creates $21,753. Now, the important factor here to remember is if they take more than that, then they run the risk of running out of money before they get to life expectancy. And based on that fact, that money that they've used now becomes illiquid if they want to make sure that they can have that steady stream of cash flow for the rest of their life. So basically, the remaining assets to be used, it goes to zero because we've tied it all up in these market accounts to be utilized for the income streams. Okay, this section right here, it shows the provisional income limits, just like we talked. They're married, and these are the percentage of Social Security that is taxable. This couple's provisional income would be $61,831. Half of the Social Security, all of this. The yield on this income, the Roth income is not included, so their total provisional income is $61,831. That is greater than $44,000, which means 85% of their Social Security becomes taxable. Okay, so if we come over here, again, I've got our progressive tax system built in, and this is assuming that tax rates do not change in the future. They are what they are today. $114,000 of gross income. Tax deductions of $25,738. I've pegged those to an inflation rate of 2%. So this is the worst case scenario. Standardized deductions and personal exemptions. They've got $25,738 there. Their total taxes to be paid then would be, as an estimate, would be $9,598, and their net total income would be $105,000 per year. Now remember, their net income need based on their lifestyle was, and due to inflation, would be $111,904. So they're actually negative. They don't have enough income to maintain the lifestyle that they're used to living, which obviously becomes problematic. So, and the fact that they're paying taxes on most of their Social Security and most of their income becomes problematic as well. They don't have more capital assets to create additional income with. So this couple would be forced to live a lesser lifestyle, or they would have to work longer, basically. Okay, so now let's look at a possible solution. So I'm going to jump to the next tab, which is I've plugged in exactly what I did before with everything else. We've got disposable income of zero, but now we're going to redirect the cash flow. So what we're going to do is we're going to drop this down to $6,000 just to continue to get the match, for example. Okay, so that's going to change the amount of money that becomes available to redirect into a better vehicle, which I'll call the Life Insurance Retirement Plan, or the LIRP, the LIRP. So Life Insurance Retirement Plan. So we've now got almost $30,000 that we've freed up. Now this is after taxes. So we went from $48,000 down to $6,000, which is $42,000 gross. That's going to free up $30,000 net of taxes. So the combined tax went up. Yes, we're going to show paying taxes on it. And the whole idea here is if taxes go up in the future, we'd rather pay the taxes now versus the taxes later. And then how much income will that create net? The bottom line is we want to create the most net spendable income possible. Okay, in addition to that, here's something else I'm going to show. I'm actually going to show converting money from the tax deferred bucket into the Roth bucket each and every year at $18,000 per year. Yes, I'm going to have to pay taxes on it at today's current tax rates, but I'm okay to do that because now that frees up more capital to then go into the tax deferred bucket. So we've got $18,000 coming out. Now I've got a total of $42,000 disposable. Now I'm going to get rid of this for now, and then I'm going to drop this down to zero for now. And what I'm going to show is $50,000 per year going into the life insurance policy. And I'm going to do a policy on each of them, $25,000 each for a total of $50,000. That leaves me disposable $11,758. I'm going to put that into the Roth bucket, for example. Of course, you could take that same money and put it into the life insurance. I'm just going to kind of keep it as I'm showing here just to kind of prove a point. Okay, Now, these remaining balances are going to continue to grow at 5%. So the future values of those from a retirement standpoint are these numbers here. What we've been able to accomplish is we've got a very minimal amount of money in the tax deferred bucket, a very good amount of money in the tax free bucket. And one thing to note is this does not include the values that will be inside of the life insurance policies. Okay? And then your taxable bucket is very low as well. And we're going to now, the Social Security income is the same. The income need remains the same. And now we're going to jump over to the next tab, which we're going to be able to start showing the income sources. Okay, so I'm going to back out of these. Now remember, earlier in our conversation, I brought up the idea behind using annuities to create lifetime income. So in the tax deferred bucket, I'm going to take the $81,531 and I'm going to put that into a joint annuity that pays out at 5.24%, which pays $42.80 per year as income for as long as both of them are alive. The next one is the taxable bucket. So I'm going to take $85,517 and put it there. And that's going to create, that's a joint annuity as well. That's going to create $4,490 per year. Now here's the important thing. Go back over to the provisional income limit. As long as we're under $32,000, none of your Social Security is taxable. How much tax are we paying? We're paying zero tax. Now we still have a lot of capital inside of the Roth accounts and in the life insurance account. So I'm going to take $602,980 in the Roth account and put it into a single annuity, a single life annuity. The reason that we're able to do that, what that means is if the annuitant passes away, that income stops. The reason we're able to do that is because we've now redirected a lot of cash flow went into life insurance, which purchased the survivorship benefits through the death benefit. So we're able to protect against premature death and that loss of income. So that creates $42,409 with a 7% distribution rate as income for life. Okay, so I'm going to show no income from the life insurance retirement plan. And now we still have a deficiency here, but we've got a ton of cash value inside of the life insurance policies that we can start using for income. So I'm going to pull up the life insurance policy on John, which is the husband, of course. And I'm going to go down to the numbers here. So $25,000 per year is going into the policy on him, and that's for 11 years. And then I'm showing a retirement income of $18,000 per year. Now I just realized I actually made a mistake here. I put $18,000 in year number 11, which it should have started in year number 12 because they're still earning income at that point. But nonetheless, numbers will be a little bit better than what they're showing here without that income in that 1 year. So I'm showing $18,000 per year of income. He's got $324,000 of cash value there and over $600,000 of death benefit. Now, as time goes on, as he draws that money down and uses it for income, which is tax-free income, by the way, if he lives to age 90 and passes away, he took all the income out at $18,000 per year, and there's still almost $300,000 of death benefit left over at that point. So I'm going to jump back. Actually, I'm going to bring up the wife's policy. And this one, actually, I'm gonna pull up the one with no income, and we're just going to show the $25,000 per year and then nothing of income coming back out. This becomes the legacy account, assuming they don't need to take any more income. They're just fine with what they have. This money just continues to grow on a tax-free basis, and if they never need to use it, it turns into $1.4 million as a legacy. So as a combination, the husband's policy and the wife's policy as a death benefit pays out almost a little more than $1.7 million as a tax-free legacy to the survivors. Plus they had all that money liquid to them for income purposes in the future. And when they take that income, it's not going to affect their taxable the taxable income and the Social Security will remain tax-free as well. That's an important factor. So I'm going to plug in the $18,000 per year of income from the life insurance retirement plan, which gives them $121,000 of total income. They needed $111,000, so they're ahead by almost $10,000 per year. So going back to the other one, they're negative by $6,500, and they've used all the assets they have to create that, and they're paying a lot of tax at that point. So going back to the one that includes the life insurance, they're paying zero tax, so they're effectively in the 0% tax bracket at this point. So as a comparison, scenario one, without our strategy, this is the total amount of tax they're paying in that first year. They got a total net income of $105,000. Scenario two is with our strategy, they've got $121,000 of income, zero taxes are paid. That's a $16,511 increase in income per year, and from a dollar amount standpoint, and a 16% increase in overall income. And we did it by reducing the risk and reducing the tax rate risk associated with, or because we're able to do it using the life insurance policy. Now I'm going to come back in here and I'm going to show the policy on the wife. So let's assume they did need to create more income. I'm going to show income from the wife's policy at $20,000 per year. That's going to reduce the death benefit down to $240,000, but then they're able to take all that income and live on during their lifetime. So basically now they've got $38,000 of income instead of just $18,000. They've got an extra $30,000. So obviously if they didn't need that money, then why take it from the life insurance? Just allow it to continue to grow tax-free. And as a comparison, they're 35% better off by implementing this strategy versus not. And that's of course assuming the tax rates do not change going into the future. So I hope that this has been beneficial. If you'd like to see your own personal numbers, give us a call. Also, this is important stuff because, as we move in as a country, we've got a lot of retirees, baby boomers getting into the retiring years, and it's important to make sure that we can create as much tax-free income as possible. So if you know anybody that would benefit from this, please send them our way, because it can become a win-win situation for everybody by them being able to implement these strategies. So I hope this has been beneficial. We really appreciate your business and look forward to many years to come. So everyone take care, and we'll talk to you soon again. Bye.